Welcome to our comprehensive guide on historical returns. In today's video, we'll delve deep into what historical returns are, why they matter, and how you can use them to make informed investment decisions. To start, let's define historical returns. Historical returns are the past performance data of a particular investment or asset class. This data is commonly used to assess how an investment has performed over various time periods. Why are historical returns important? By analyzing historical returns, investors can get an idea of how an asset or portfolio might perform in the future. However, it's crucial to remember that past performance is not a guarantee of future returns. Let's look at a simple example. If you invested in the S&P 500 index 10 years ago, you might want to know its historical returns over that period. This helps you understand the potential volatility and average returns you could expect. Questions to think about. What factors influence historical returns? How do you calculate the annualized return? Stay tuned as we explore these questions. Now, let's visualize the historical returns of the S&P 500 over the last 10 years. We'll use a line chart to depict this data. You might notice that some years have positive returns while others have negative returns. This is natural market volatility. Average annual return takes these fluctuations into account to give a smoother growth rate. Let's calculate the average annual return for this 10-year period. Add each year's return and divide by the number of years. This gives us a simple average return. Using our equation, the average annual return is approximately 11.96%. This average can help you set realistic expectations and plan your investment strategy. Another concept related to historical returns is the risk-adjusted return, measured by metrics like the Sharpe ratio. Example, if your portfolio had a return of 15%, a risk-free rate was 2%, and the standard deviation of your portfolio's excess return was 10%, the Sharpe ratio would be 1.3. Here's another important metric: compound annual growth rate, CAGR, which smooths out the returns over a period, assuming returns are reinvested. For instance, if you invested $1,000 and it grew to $2,000 over 5 years, the CAGR would be calculated as follows. Historical returns are also useful for understanding the performance of different asset classes. Let's compare the 10-year historical returns of stocks, bonds, and real estate. As you can see, stocks generally offer higher returns compared to bonds and real estate, but they also come with higher risk. Let's take a moment to answer a frequently asked question. How should I use historical returns to build my portfolio? The key is diversification. By spreading investments across various asset classes, you can mitigate risk while aiming for reasonable returns. For example, a diversified portfolio might include 60% stocks, 30% bonds, and 10% real estate. This mix can provide a balance between risk and return. In conclusion, understanding historical returns is crucial for making informed investment decisions. It helps in setting realistic expectations, assessing risk, and building a diversified portfolio. Thank you for watching. Don't forget to like, share, and subscribe for more financial insights and tutorials. If you have any questions, leave them in the comments below.